Good morning, everybody. Welcome back to the Opportunistic Trader. It is November 7th, just before 10 o'clock, and we're joined now by Phil Flynn of the Price Futures Group and Fox Business Contributor. How's it going, Phil?
I'm doing good this morning, doing really good. It's nice to have the elections over with, and well, now we can go back to, TV with no campaign ads, which is going to be a nice change.
Exactly. That's what we were just saying. All those the advertisers need to figure something else to fill all the time slots with.
there, there you go. I'm sure we'll have some good beer ads coming up here pretty soon, I hope.
Yeah. So I want to talk to you. We got crude oil's been very interesting recently. Been very active, and we have the DOE report coming up in about 30 minutes. But before we get into that, I wanted to start out just your thoughts
Mhm.
on the global equity markets here. Over the past 8 days, we've had a significant rebound. We were trading in the S&P down to I think about 2603 or so was the low about 8 days ago, and here we are 2777 right now. What are your thoughts
It
on
is.
equities?
Yeah, we've had a couple really nice updates. I think some of the best updates since early October. And it really looks very well. November is traditionally a very strong month for the stock market. On top of that, when you have a midterm election, history shows that stocks do very well, especially in a gridlock situation. And in the past, we've seen gains in November of anywhere from 10 to 17% after a midterm election. So the history would suggest that we're in for a pretty good stock market. And let's face it, a lot of the things that we were worried about in October, we were worried about in 2016 and 15. And, we know that we're going to have a Fed meeting later today that could lay the groundwork for higher interest rates. We know the economy has been getting better. We know the dollar's been strong, but the overall growth, the underlying growth in the economy has been so strong that I think that it's going to bode very well for stock prices going into the end of the year. Today, Caterpillar and Amazon, two of the stocks nobody wanted, in October, all of a sudden are the darlings of the market today, leading the way back up. And it goes to show you that a lot of the selling, in Amazon and in Caterpillar was really based off short-term earnings as opposed to any longer-term outlook for either one of those firms. I mean, Caterpillar obviously has had some concerns about the trade war situation, and that's been an issue for them. But both of those companies are going to do well over the next couple of years. And so I think the market's starting to focus on the big picture as opposed to some of the minute, you know, earnings to earnings reports. So it looks really good for stocks.
Yeah, it's interesting to take a look sector by sector. But yeah, you point out two interesting names. Caterpillar's been very active, and they had disappointing earnings. We traded down, I believe, to about 210. I'm sorry, 110 and about in Caterpillar, and here we are back at 130. But we also did come from about 160, so still some room there. But let's talk about energy markets here. DOE report coming out in 30 minutes. What are we expecting? And what was the API last night?
Well, the API, there was a shockingly bearish number for crude oil. They reported a 7.83 million barrel increase in crude supplies. And a lot of that was in Cushing, Oklahoma, where they showed a whopping 3.07 million barrel build in crude supply. And because the market has been under such pressure over the last couple of months, this was considered to be a very bearish number. But one of the concerns that I have, and I wrote in my report today, it's like, too bad you can't run crude oil through your factories or your trucks or your trains or everything, because it doesn't matter because we have a very tight supply of distillates right now, and that's the issue. If the API is right, we dropped another 3.64 million barrels in distillate inventories. That's putting supplies basically 5 or 6% below the 5-year average. demand for these products are probably 7 or 8% above average. And so we're getting into a situation where we could see spot shortages. Even yesterday, the Energy Information Administration put out a report basically saying, hey, when it comes to distillate supplies, we have a very tight market globally, and that they see that continuing into winter. So we've got a situation right now where the distillates could see some big price spikes. Now, I said in my report, the market right now has been following crude. Crude's been leading the market. I think as we get into winter, it could be the distillates that start to lead the entire complex. Interestingly enough, if you look at the recent sell-off, if you would have been basically long the products and short the crude and correctly weighted, you actually would have made money because, during the recent sell-off, the products, even gasoline, has held up a lot better than the crude. So once the refiners start to come out of maintenance, we think that they're going to have to run at a record pace to keep up with demand. So that should give us a bottom on the market. But the other big news today, oil is up a little bit today. It's kind of fading from its earlier gains. But there is, reports right now that Saudi Arabia and Russia are getting ready to cut production. And there is a lot of concern that by those countries that Donald Trump hoodwinked them. That's right. They were hoodwinked. They were pressured by Donald Trump to raise production, in part because of the Iranian sanctions. And so they dutifully followed President Trump's recommendation and raised production. And how did Donald Trump repay them? Well, they repaid them by granting waivers to 8 different countries, helping to crash the price of oil another $5 to $10 a barrel. Now, when we talk about what a break that is, that's billions of dollars for these countries. And they're kind of upset right now, that they bought into this Donald Trump story of, cutting out, total supplies from Iran. And so now they're going to want to take oil off the market. There's reports that the Saudis are raising prices already to slow down the demand for their oil. There is reports, in the big picture that Russia is on board with raising production. And so that's something we're going to have to watch here the next couple of days. The way the market's fading today, it seems technical. The market's had a hard time holding any rallies especially since Donald Trump granted the waivers. So the market on crude is still technically weak and still concerned about a so-called slowdown in demand and a potential supply glut. And I don't know what it's going to take to get the market out of this funk, but I do know this. I am concerned about the shortage possibility of diesel fuel, and I think that will lead the market back up at some point. I think we're a lot closer to the bottom than the top. But there's been, severe challenge to the market technically. Commodity funds, a month ago, we dipped in the bear market territory, down 20% from the top. A month ago, commodity funds were talking about $100 a barrel. Now they're talking about being short at these levels. So it's really been a change in attitude. And I've seen these funks in oil. Sometimes they can last a little bit longer than you think they should, but we still are a big believer that this is going to be a strong buying opportunity going into this year and next year. Buy some calls down here, put on some bullish strategies. If you think there's another dollar or two on the oil, you can buy a put as well. But we really feel that, that we could see a V-shaped recovery in this market at some point. We go back to the stock market, right? Everybody was, the stock market, nobody loved the stock market a few months ago. I had more and more people calling for the October crash. They were coming out of the woodwork. This is the big one. The bull market's over, and then yet here we are in November, and the market's looking pretty good. So, I think we'll see a similar change in attitude on oil here pretty soon.
Well, it's interesting. I have a chart up for everybody to see. Basically, the last 7 or 8 or 9 trading days of crude, and it's been straight down. And the interesting price action also is it's been about starting at about it's somewhere between 10 and 11 a.m. We get kind of a reversal. Maybe the market's bid in the morning, then it gets offered in the late morning to early afternoon, and so it'll be
Yeah.
interesting to see how that trades today. But in that
Well,
past
did
seven
it
or eight
again
days,
today. Yeah.
yeah,
Yeah.
exactly. So
Yeah.
far, and we have the data out in 20 minutes, but the over the past 8 days, we've seen the equity market straight up and oil market straight down. So that's kind of been
Out of the norm, right, from what you usually have think. I mean, over the big picture, if I showed you a chart of crude and S&P, generally they go in the same direction, big picture, but really shorter term, the correlation between the two aren't really that close a lot of times. I mean, over the long term, when the economy is doing good and stocks are doing good, you use a lot more oil. In recent days, there are times where the market is influenced by the stock market, and we've seen that on big down days. Oil's up, stock market crashes, and people take profits on oil. Fund traders that are in everything, they're losing on stocks, so they sell their oil as well. But it's unusual. Now, some people are looking at that differential as to saying that this is a key point. Either what the oil market is telling us is that the global economy is going to crash and the stock market's got it wrong, or the stock market's got it right and oil is way undervalued. I think the truth is somewhere in between. I think that oil probably at this level is undervalued because we talk about elections have consequences, right? When you have a 20% break in oil in a short period of time, it has consequences. This is not a static market. I mean, we have a market that's counting on U.S. shale producers to raise production to an average of 12 million barrels of oil a day next year, right? That's what the IEA is telling us. The problem is they can't make money, at $61 a barrel. They can't make money at 70. They can barely make money at 70. So how are they going to make money at 61? So what that means is that if we stay down at these levels, we're going to see a cutback in the oil rig counts. We're going to see potential bankruptcies of some shale firms or reorganizations, and you're going to see less rigs go in. And it's happens every time. And so the recent increases that we've seen in production and the rig counts will get reversed on this. And if it's probably going to happen already, I think the damage is done. But that's long-term bullish for oil, even though short-term it's bearish, longer-term it's bullish. The Saudi situation, same type of deal with the prices being down. They are going to cut back. They're going to have to cut back on production. They can't afford oil at $60. Remember, it was just a month ago or two that the Saudis said they were happy with oil at $80. They thought it was a fair price. And now we're at 60. You think that's a fair price? I don't think so. Mm-hmm. So you're going to see them cut back on production. So I don't know how quickly the cycle is going to change, because obviously this is a market that's been damaged technically and psychologically. And it may be the distillate number that has to turn us around.
Well, I think that's the key point, what you just mentioned before there, how the psychological damage here of, just trading $77, being caught in a strong uptrend, having the trend followers, having momentum, everything on your side. And then in, 20 trading days, now we're basically closer to almost on the low of the year. So,
well, we've seen that happen in the stock market. I mean, day traders paradise. I mean, I'm hearing, the guys that are, swing trading is great. Like you said, you get a little rally, you sell into it every time you make money, right? So that's been a great trade. But you're right. We saw the same thing in the stock market a couple of weeks ago. Oh my gosh, we gave back the gains for the entire year, all gone, all the gain, in 1 month or a short period of time. So it takes a while for the market to get off of that and get back to normal. I don't know if we're there yet on oil. I think we're pretty close to being there. I think we're there in the stock market. I think the stock market is getting back to a point where it's
so. But on a price action standpoint, just sticking to oil, on a price action standpoint, where would you kind of throw in the towel and move to the sidelines on your bullish call, or
Mhm.
potentially even get bearish? Because I know initially you've been talking for a while, the only reason you'd get bearish is global economy, something like that, or U.S. economy, global economy turns down.
Mhm.
But on a price action standpoint, where would you kind of, start to move to the sidelines?
Um, I mean, if you haven't already, you shouldn't at this point. I mean, one of the ways that we trade it longer term is that we will have futures that'll be protected with puts and options for a floor to ride out, the correction. This is one of the biggest corrections we've had probably in at least 2 years for oil. Um, and I mean, from a technical viewpoint, you're in a bear market now, but we were in a bear market in stocks and that was the low, right? So I guess from a technical viewpoint, you should have already been short. So uh, from that point, I mean, if it depends on how you're trading. If you're trading as a swinger trader, I mean, obviously it was a great short up there at 77. But if you're trading for the long term, or a hedge fund, where is oil going to be a year from now, or where is it going to be at the end of the year? um, and you, in the beginning of the year, when oil was at 40 and 50 and 60, and we still think oil could be at $84 by the end of the year, and based off our charts, there has been nothing in this correction that has us change that forecast. And I'll remind you, when oil was at 77, we thought that was too much too soon. And, you asked me, hey, Phil, people are talking about $100 a barrel. What do you think? And I said, no, we don't see that, not this year or next year. And you had a lot of people that were just a month ago saying, $100, it's in the bag. No, we've kept that $84 forecast. We've had some wild swings on this market. Oil does that. They go up, they go down. We've had some swings, some $10 corrections. Percentage wise, this is the biggest one we've had. But you if you look at even this year, you see how fast this market can recover. Oil can recover quite quickly. And admittedly, and if you're worried about a big sell-off, I mean, this is a great time to buy cheap calls. We were buying 72 calls for clients today. For January, they're practically giving them away. And it looks like a long shot, but it looked like a long shot that oil could fall from 77 to 60, 61 or 62 in a month. So if it can fall that hard, it can rally back that hard.
Yeah, well, it's definitely a volatile instrument. There's no doubt about that, and it has a lot of momentum when it starts moving in one direction. And
Yeah.
right now, we are on the downward momentum side of it. But we'll see if this DOE report might be something that starts the momentum in the other direction.
Be excited. The early line that we're hearing, and here I'll run through the numbers.
Yeah.
API said 7.83 up. We're hearing from inside sources, or the whisper numbers, that we could actually see a drawdown in that number today. Now, again, these guys are going off of a lot of different information. They could be wrong, they could be right, but that could be a situation where you could get a big bounce. Cushing is the problem. Okay, they actually, the CME's basically going to be are going to try to phase out Cushing as the benchmark, because it's not giving us a clear signal. They started a new Houston futures yesterday, traded 26 contracts, because they think Houston Gulf Coast is a better indicator of what's really going on with the market. We talk about WTI being at 61. Well, if you look at what's happening with the Gulf Coast, it's trading around $67. So there's a huge premium. And a lot of the CME seems to suggest that number is more reflective of supply and demand. But that will be a problem. They showed a 3 million barrel increase on EIA. Private forecasters kind of confirmed that number is probably not that far off. More like 2 million, 2.3. So that's going to be a number to look at. And that could be one of the determining factors. But if you look at exports this week, it's going to be huge. If you look at the fact that we are um, um, if you're looking at the fact that we're seeing exports pick up, we're seeing a possibility of another release from the Strategic Petroleum Reserve. It's making it difficult to call. But if we don't get a release from the reserve, it's very possible that we could see a drawdown in inventories. And the products, those are going to be the big ones. We go back to the distillates, they're below average for this time of year. That's going to be a problem spot. That's going to start leading the market.
Yeah, well, a lot of interesting things going on here. Important report coming out, especially where we are price action wise, especially given what we were pointing out before. The recent trend has been afternoon weakness in the oil market.
Right.
So, we'll keep a close eye on it. It should be an interesting report. Thanks for the
You
update
got
and all
it.
the info.
Thank
We'll
you.
talk to you later.
All right, buddy. Thanks, Mike.
All right, that's Phil Flynn of the Price Futures Group and Fox Business Contributor.